6 years in a row, the most respected business magazine in America named this company the most innovative in the country. Not once, 6 times. It reported $101 billion in revenue. Its stock hit $90 a share. Presidents took its calls. Business schools taught it as the future. Card, most innovative company. 6 years running. And then, on the 2nd of December, 2001, it filed for bankruptcy, the largest collapse in American history at that point. 20,000 people lost their jobs. Many lost their life savings on the same day. And here is the part that still doesn't feel real. Almost none of the profit had ever existed. It had been invented, legally, on paper, in plain sight, while everyone whose job was to check simply chose to applaud. This is the story of Enron. Not just that it lied, but exactly how you fake being the most admired company in America, one imaginary dollar at a time. Enron started as something boring and solid: pipelines. In 1985, a Houston executive named Kenneth Lay merged 2 gas companies into one and began turning a sleepy utility into something stranger. A company that didn't just move energy, it traded it, like a bank trades money. To finish the transformation, Lay hired a man with a vision that would make Enron famous and then destroy it. His name was Jeffrey Skilling, a former McKinsey consultant who believed old companies were fools for owning things. Factories, pipelines, hard assets. The future, he argued, belonged to ideas, contracts, and traders. Enron would be an asset-light company. And to make that vision shine on paper, Skilling brought in an accounting method that is the first key to the whole illusion. It's called mark-to-market. Here's the trick in one sentence. The day Enron signed a long-term deal, it was allowed to book all the profit it imagined that deal would earn over the next 10 or 20 years as income today, not money in the bank. A guess about the future, recorded as present-day cash. Sign a deal, project a fantasy, report it as earnings that quarter. If the profit never actually came, no matter. By then, you'd signed the next deal. Wall Street loved it because the numbers only ever went up. Analysts rated it a buy. Fortune magazine crowned it the most innovative company in America, again and again. Nobody wanted to ask the obvious question: how does a company book record profits on deals that haven't paid a cent? Because the stock was climbing and everyone in the room was getting richer by not asking. But imaginary profit creates a very real problem. When the fantasy earnings don't turn into cash, the losses and the debt pile up somewhere. They have to go somewhere, and hiding them would require a second trick, darker than the first. The work of the man Skilling made Chief Financial Officer Andrew Fastow. Fastow built a maze. He created dozens of separate companies, off-the-books partnerships with strange names like LJM, Chuco, and the Raptors. On paper, they were independent. In reality, Fastow controlled them. Enron would quietly sell its losses and its debt to these shadow companies, so they'd vanish from Enron's own balance sheet. The debt didn't disappear. It was just moved somewhere the public couldn't see it. Card. $101 billion in revenue. Most of the profit was fiction. And Fastow built in one more twist for himself. Because he ran the shadow companies that Enron was doing business with, he was on both sides of every deal, and he paid himself tens of millions in the process. The man hired to protect Enron's books was quietly looting them. Enron's own board waved the conflict through. By 2000, the arrogance had spread beyond the books. When California's electricity market was deregulated, Enron's traders gamed the entire state, inventing schemes with cartoon villain names like Death Star and get shorty. One trick billed California for relieving congestion on the power grid without moving any electricity at all. They helped plunge a state of 30 million people into rolling blackouts and laughed about it on tape. Inside the company, one executive finally said it out loud. In August 2001, a vice president named Sharon Watkins wrote to Ken Lay warning that Enron might implode in a wave of accounting scandals. That same month, Jeffrey Skilling, the architect of it all, abruptly resigned after just 6 months as CEO. He said it was for personal reasons. Then, it all came apart at once. Enron admitted its numbers were wrong and quietly erased years of fake profit. The stock collapsed from $90 towards zero in weeks. Its accountant, Arthur Anderson, one of the most trusted names in the world, which had been paid to audit Enron and to consult for it, started shredding Enron documents by the truckload. That firm would not survive either. On December 2, 2001, Enron filed for bankruptcy. Around 20,000 people lost their jobs. Many had been encouraged, sometimes required, to hold their retirement savings entirely in Enron's stock and were locked out from selling as it crashed. Their savings evaporated. Meanwhile, the executives at the top had quietly sold hundreds of millions of dollars of their own shares on the way up. Card, 20,000 jobs, and their savings gone. The reckoning came slowly. In 2006, both Ken Lay and Jeff Skilling were found guilty of fraud and conspiracy. Skilling was sentenced to 24 years in prison. Ken Lay died of a heart attack that summer before he was sentenced. And because he died before his appeal, his convictions were legally erased. Fastow, who cooperated with prosecutors, served about 6 years. Congress passed a new law, Sarbanes-Oxley, forcing chief executives to personally sign off under threat of prison on the truth of their numbers. But the real lesson of Enron isn't about one accounting trick or one greedy CFO. It's this: Enron's actual product, in the end, wasn't energy. It was its own story, a stock price that everyone from analysts to auditors to magazine editors was paid, one way or another, to keep believing. The fraud wasn't hidden in a vault. It was published quarter after quarter in plain sight and celebrated because doubting it was bad for business. Bre-X faked the gold. Barings hid the losses. Enron did something more modern and more unsettling. It manufactured the profit itself and got the smartest people in America to sign off on it. When everyone in the room makes money by believing the number, nobody in the room will be the one to check it. Next case file: a German tech company worth $24 billion. That was missing $2 billion it claimed to have, money that may never have existed at all. Subscribe.